Let us see the next question. Consider following information. Sales of a company is given as 10 lakhs. Opening stock is 1 lakh. Closing stock is 2 lakh. Purchase is 8 lakh 50,000. 10% debentures is of 5 lakhs. Selling and distribution expenses 70,000. Amount of depreciation is 30,000. Income tax rate is 30%. 15% preference share capital is 2 lakhs. Equity share capital is 7 lakhs. Proposed dividend for equity share capital is 4%. There is an administration expenses of 10,000. You are required to prepare P&L account, P&L appropriation account, and so on. Further questions are given. So first of all, let us have understanding how to prepare the P&L account. Dear students, we can see that we have been provided with the opening stock, closing stock, and purchase. With this three information, we can calculate the COGS. COGS will be deducted from the revenue to calculate the GP. So we'll get the credit side of the P&L account. Afterwards, all expenses information have been given, like interest, selling and distribution expense, depreciation, administration expenses. All of them will be deducted to compute the profit, and with that, so we'll prepare the P&L account. I request all of you to write down answer along with me. Answer for the first question in the write down heading profit and loss account. In the write down, working note number 1, calculation of gross profit. Gross profit is calculated as sales minus cost of goods sold. Sales is 10 lakhs. Cost of goods sold is opening stock plus purchase minus closing stock. The amount of the opening stock is 1 lakh. Purchase is 8 lakh 50,000. Closing stock is 2 lakhs. So the COGS is 7 lakh 50,000. So gross profit is 2 lakh 50,000. So the first working note is of the gross profit. Next, profit and loss account. I request all of you to prepare the P&L account and post your answer of the profit or loss of the P&L account in the chat box. So let us start with the P&L account. Column number 1, particulars. Column number 2, amount. Column number 3, particulars. Column number 4, amount. On the credit side, we will have gross profit. Amount of the gross profit on the credit side is 2 lakh 50,000. On the debit side, we will have like interest, amount of the debentures is 5 lakhs. Rate of interest is 10%. That comes to 50,000. Then selling and distribution expenses. It is an amount of 70,000. Then depreciation. It is an amount of 30,000. Income tax rate is given. That will be useful to calculate the tax provision. Then administration expenses are given. It is an amount of 10,000. So what we can do, we can compute at this point of time earning before taxes. So it is 50,000 plus 70,000 plus 30,000 plus 10,000. So there are total expenses of 1,60,000 that is deducted from 2,50,000. So profit before taxes is 90,000 and tax rate is 30%. So the income tax provision is required to be made of 27,000. So two income tax provision, that is an amount of 2,50,000 minus all these expenses 50, 70, 30 and 10. All of them are deducted from 250 into tax rate. So 2,50,000 minus 1,60,000 into 0.30. So it is 90,000 into 0.30. That is 27,000. So we'll have the net profit of 63,000. We can also that it is earning after taxes. Credit side total is 2,50,000. Debit side total is 2,50,000. And the balancing figure will be profit, that is 63,000. Second question is we are required to prepare P&L appropriation account. Dear students, as far as the P&L appropriation account is concerned, in that there will be payment of the preference dividend that we have to show, and so we are required to show the proposed equity dividend. Since that is proposed equity dividend information is given, so it is implied that so the company must have paid, that is the company has to pay preference dividend before that. So heading right down, P&L appropriation account. I request all of you to prepare it on your own and then I will do for you. So again we will have the working like this. Column number 1 is particulars. Column number 2 is amount. Column number 3 is particulars. And the last is amount. We'll have the profit over here. That is earning after taxes. It is an amount of 90,000. Sorry, 63,000. Then we will have two preference dividend. The amount of the preference share capital is 2 lakhs and the rate of preference dividend 15%. That comes to 30,000. Next is 2 equity dividend. Amount of equity share capital is 7 lakhs into 4%. That comes to 28,000. So now 63,000 minus 30,000 minus 28,000. That comes to 5,000. So this is what we understand. Transferred to balance sheet. Credit side total is 63,000. Debit side balancing figure is 5,000. Please write an answer. P&L appropriation account. Third question, we are required to make the calculation of earning per share assuming the face value of equity share is 100. I request you to do answer for the third question and put your answer in the chat box. So we understand that, say, we can compute the answer like this. Column number 1 particulars, column number 2 answer. I request all of you to write down answer along with me. Earning after taxes, we already have found it 63,000 rupees. Less preference dividend. We already have found amount of the preference dividend is 30,000. 63 3 minus 30 is earning available to equity shareholders, 33,000. The same will be divided with the number of equity shares. The question is providing the information to you that the amount of the equity share capital is 7 lakhs and face value of the equity share is 100. So what will happen? 7 lakh rupees is the share capital and 100 rupees is the face value. So the number of equity shares are 7,000. So use your calculator. 33,000 divided by 7,000. That is 4.7143. So earning per share 4.7143. So it is 33,000 divided by 7,000. That is the way EPS is calculated. Please write down answer. Always remember, friends, when we are calculating earning per share, then whatever the equity dividend that, say, we pay to the equity shareholders will never be deducted. However, the preference dividend is required to be deducted in order to compute earning per equity share. Next, calculate dividend yield to investor if the market price per equity share is rupees 40. This is also given a name as gross yield percentage. That is a question. So over here, you have to understand the question that says this answer is required to be computed from equity shareholder point of view. That is the first thing. This answer is required to be found from equity shareholder point of view. That is the first thing. Second, this answer is required to be calculated in terms of return to equity shareholders for the dividend income. Return to equity shareholders for dividend income. That is what we are required to calculate over here. So we are supposed to make the calculation of the answer in this way. Answer for the third question, in that dividend yield to equity shareholder. Answer will be found as DPS upon MPS into 100. See, what is the face value of the equity share? It is 100. What is the rate of equity dividend? 4%. So 4 rupees is the equity dividend income and market price of the equity share is 40. So we understand that an investor who is purchasing the equity share for 40 rupees is able to get the equity dividend of rupees 4. So for every 100 rupees of the investment, he will get a return at the rate of 10%. That is the way we are supposed to calculate the dividend yield. Yield stands for the return. Always remember that. Dividend yield stands for return to the investor for the dividend income. And since market price of the equity share is given, this answer is required to be found from the equity shareholders point of view. Write down a note for the answer. Yield means return. Full stop. Dividend yield means return to investor for dividend income. Full stop. Since information is given of market price of equity share, we have to find return from equity shareholder point of view. Full stop. One more time, I'm giving some explanation of this. See, we have to understand logically in this way. For example, say there is a test in your like the class, and suppose the test paper was of 80 marks, and you got, let us say, 60 marks. Then basically you may say that say I got 60 marks, or you may say that say 60 out of 80, then for every 100 it is how much? You convert that into percentage term, it is 75 percentage. So what is your result? Either it is 60 marks or it is 75 percentage. This is what we understand. Now, as equity shareholder, what amount of the dividend income that you receive? It is 4. And what is the return that you receive being equity shareholder in terms of the dividend income? What is the return that you receive in form of dividend income? We can say that's the investment and income. For 40 rupees of the investment, income is rupees 4. For 100 rupees of the investment, income would be how much? So we make the computation in percentage term like this. For 40 rupees it is 4, then for 100 rupees it is how much? Then in that case it comes to 10 percentage. That is what we understand. Next question. Calculate price earning ratio. So write down answer for the next question, question number 5. Price earning ratio. It is calculated as MPS upon EPS. Dear students, everybody is requested to pay attention. 40 rupees is the market price divided by earning per share. Earning per share is 4.7143. So 4.7143. So 40 divided by 4.7143. That is 8.48 times. Okay. Let us have understanding that say how to interpret this value. I take some simple example, simple values to give explanation to you. Suppose a company has market price of the equity share of 50 and its earning per share is 10, for example. So market value is 50 for earning of 10. So for 1 rupee of the earning, what is the price? Is called price earning ratio. It is MPS upon EPS. So the answer is 5 times. What does this say? The 5 times is indicating that for every 1 rupee of the earning, market value is rupees 5. For every 1 rupee of the earning, market value is rupees 5. That is what it indicates. Whenever the price earning ratio will, whenever the earning of the company will increase, the market value of the company will increase at the rate of 5 times. Presently the earning is 10, market value is 50. Your earning increases from 10 to 12. So it increases by rupees 2, then it will reflect in terms of increase in the market value by 10. That is 2 into 5. And when there is a fall in the earning, again the market value will fall, and so it will fall at the rate of 5 times. Suppose the earning reduces by rupees 3. So 3 into 5, it will reduce by 15 rupees. That is what we understand. This is what say we have a kind of price earning ratio. Please add an answer. Then I will dictate a note to you. So write an answer for the question further. Price earning ratio is indicating what is market price of equity share for every 1 rupee of earning. Full stop. If PE ratio, price earning ratio as a short form, PE ratio is 10, it means market price of the share is rupees 10 for every 1 rupee of earning. Full stop. With the increase in earning, market price of share will increase by 10 times, comma, and at the same time it will fall down at the same rate. Full stop. Next question. Calculate cover for preference dividend. Fifth question answer. Cover for preference dividend. Everybody is requested to pay attention. See, the way we have interest coverage ratio, Similarly, we have a term called cover for preference dividend. Let us understand and say how does it work. Listen carefully. See, the interest coverage ratio is calculated as EBIT upon interest. It is indicating ability of the company to make payment of interest. Suppose the interest coverage ratio is, for example, 5. It means that say for every 1 rupee of the interest to be paid, you have the operating income of 5. That is what this ratio indicates. Higher the ratio will be, that is indicates sound financial position and vice versa. There is a term called cover for preference dividend. It is calculated as, listen carefully, earning after taxes divided by preference dividend. The way interest coverage ratio is indicating that what is the ability of the company to make the payment of the interest. Similarly, preference dividend coverage ratio is indicating what is the ability of the company to make payment of the preference dividend. Higher the coverage ratio is indicating that the company's financial position is sound and vice versa. That is the first thing. The second thing is that you can very well understand that the interest is paid out of EBIT. So we have the formula EBIT upon interest. Similarly, the preference dividend is paid out of earning after taxes. That is the reason, say we are having the formula as earning after taxes upon preference dividend. So let us answer the question. Preference dividend coverage ratio indicates that what is the ability of the company to make payment of preference dividend. Full stop. It is similar to interest coverage ratio. Full stop. Over here, we take earning after taxes in the numerator. Because preference dividend is paid out of earning after taxes. So that one answer. Preference dividend coverage ratio. It is earning after taxes upon preference dividend. Earning after taxes is 63,000 divided by amount of the preference dividend is 30,000. So the answer is 2.10x. That is 2.10 times. Please add an answer. Next question. Cover for equity dividend. So seventh question. Cover for equity dividend. Dear students, it is exactly the same as the cover for the preference dividend. It is indicating the ability of the company to make payment of equity dividend. So write down answer. It is earning available to equity shareholders divided by equity dividend. This is earning available to equity shareholders divided by equity dividend. So it is earning after taxes minus preference dividend divided by equity dividend, that is 4% of 7 lakhs, that comes to 28,000. Amount of earning after taxes is 63,000 minus amount of the preference dividend is 30,000 divided by 28,000. So 33 upon 28 divided, that comes to 1.1786. That is the way we compute the preference equity dividend coverage ratio. Next is the net profit ratio. That's very simple. Net profit upon sales into 100. So answer for the question number 9. Sorry, 8. Net profit ratio. It is net profit upon sales into 100. Net profit is earning after taxes divided by sales into 100. Amount of the earning after taxes that say we have calculated, it is an amount of 63,000 on sales of 10 lakhs into 100. That comes to 6.30%. Ninth question. Calculate earning yield to the investor. Dear students, we know that the earning per share is calculated always for the equity shareholders. It is never calculated for anybody else. So this ratio is required to be computed from equity shareholders point of view. That is the earning yield to the share, that is to the investor. Earning yield to investor. In the breakdown, earning per share upon market price of the share into 100. Earning per share we already have calculated. It is 4.7143 divided by 40 rupees into 100. So 4.7143 divided by 40 into 100. That comes to 11.79%. That is the way earning yield to investor is found. So once again you have to understand over here the answer in this way. Yield is calculated from whose point of view? That I'm sorry, yield means so the return. Yield means return. Now the question says that to the investor. So basically the debenture holder is also investor, preference shareholder is also investor, equity shareholder is also investor. However, since the question is providing earning yield to the investor, means they are talking about the equity shareholder. That is what we have to understand. Why? Because we understand that so the equity shareholder, from his point of view only, we make the computation of the earning per share. That is the reason. 10th question. Calculate net fund flow. Calculation of net fund flow. Friends, it is a small accounting concept that we have, wherein it is calculated by using a simple formula like this. It is earning available to equity shareholders minus equity dividend. So this is technically called retained earning. Retained earning plus we add depreciation to it. Earning available to equity shareholders is 63,000. Amount of the equity dividend is 28,000. I'm sorry, this is 33,000. This is 28,000 plus depreciation. Why depreciation is added back? Because it is a non-cash item. So what is the amount of the funds which is available for the purpose of expansion of the business, that we will be able to calculate. Net fund flow is only a technical value which indicates what is the amount by which we can expand our business. So this is 5,000. That is retained earning transferred to reserves and surplus balancing figure of the P&L appropriation account plus 30,000 of depreciation. So the final answer is 35,000. I request you to write that answer. So let us have the revision of the entire answer. In the first question, we have been asked that you have to prepare the P&L account. So first of all, we compute the gross profit. Then we prepare the P&L account. On the credit side, we'll have the gross profit. And on the debit side, we will have all expenses which are deducted from the gross profit to compute the PBT. And say tax is calculated at the rate of 30% and profit after taxes is found. In the second question, we are required to prepare the P&L appropriation account. So we start with the profit after taxes minus preference dividend minus equity dividend, and if at all there is any transfer to reserve, it will be deducted to find the amount which is the transfer to the balance sheet. Third question is extremely simple, EPS calculation, that starts with the earning after taxes minus preference dividend is earning available to equity shareholders divided by number of shares, that will give EPS. Next question is dividend yield, means return in form of the dividend to equity shareholder, that is dividend per share upon market price of the share into 100. It is a kind of calculation of the result in percentage term. For 40 rupees of the investment, because investors are making investment at the market price, you get dividend income of 4. So 4 against 40, then for every 100 rupees it is how much? 10. That is what the dividend yield. Next is the price earning ratio. So what is the market price of the share for every 1 rupee of the earning per share? So for 4 rupees 71 paise of the earning, market price is 40. So for every 1 rupee of the earning, what would be the market price? It is 8.48 times. Price earning ratio is indicating that what will be the rate at which the market price of the equity share will fluctuate for every 1 rupee of the change in the earning. Then cover for preference dividend, very similar to the interest coverage ratio. It is earning after taxes upon preference dividend. This is measuring what is the ability of the company to make payment of the preference dividend. So it is calculated as EAT upon preference dividend. Next is cover for the equity dividend. it is earning available to equity shareholders divided by equity dividend. So it is earning after taxes minus preference dividend divided by equity dividend. So 33 upon 28 is 1.1786. Next is the net profit ratio. It is net profit upon sales into 100. So earning after taxes is 63,000 divided by sales of 100. So divided by sales of 10 lakhs into 100. That is NP ratio is very simple. Earning yield to investor, that is to equity shareholder, because earning per share is calculated only and only for equity shareholder. That is MPS upon EPS into 100. It is very similar to the dividend yield. The only difference is that, say, instead of dividend, we'll use the market price. Next is fund flow. That is an accounting concept. That is a retained earning plus depreciation. Depreciation is added back because it is a non-cash item. Retained earning is earning available to equity shareholders minus equity dividend. That is the way we compute the net fund flow.